Imagine someone hands you $10,000 and asks you to invest it, not to gamble, not to chase the latest hype, but to build real lasting wealth. What would you do? In this video, I'll walk you through exactly how I'd approach this challenge, focusing on a balanced, smart, and long-term strategy. We're not here to make risky bets or let inflation quietly erode our savings. Instead, we'll build a portfolio designed for steady growth, reliable income, and the potential for big upside, all while keeping risk in check. Let's dive in and see how this plan comes together. Before we get into the details, let's set some ground rules. This isn't about getting rich overnight or timing the market perfectly. Instead, it's about building a portfolio that can weather ups and downs, grow steadily, and provide opportunities for the future. We'll focus on diversification, compounding, and emotional discipline. Remember, this is educational content, not financial advice. The goal is to show you a framework you can adapt to your own needs and risk tolerance. Heart of this approach is balance. I'm spreading the $10,000 across different types of investments, each with a specific role. We use broad market ETF for stability, high-growth tech stocks for upside, dividend stocks for income, and a controlled slice of crypto for asymmetric potential. This mix is designed to capture growth, manage risk, and keep your portfolio resilient in all kinds of markets. Let's break down each part and see how it fits into the bigger picture. First up, 40% of the portfolio goes into conservative ETFs like VOO, IVV, and SPY. These funds track the S&P 500, giving you exposure to the largest, most stable companies in the US. They're the bedrock of the portfolio, helping to reduce risk and smooth out volatility. Over time, these ETFs have shown steady growth, and by reinvesting dividends, you can harness the power of compounding. This foundation is what keeps your portfolio grounded, no matter what the market throws at you. Why choose S&P 500 ETFs like VOO, IVV, and SPY? These funds represent a broad slice of the US economy, covering everything from tech to healthcare to consumer goods. They're managed to track the overall market, which means you're not betting on any one company or sector. This diversification helps protect your investment from big swings and gives you a solid base for long-term growth. Plus, the fees are low, so more of your money stays invested and working for you. Next, 25% of the portfolio is dedicated to high-growth stocks. Think Apple, Microsoft, Nvidia, Amazon, Google, Tesla, and Meta. These companies are at the forefront of innovation, driving advances in artificial intelligence, cloud computing, and future technologies. By investing in these leaders, you're aiming to outperform the market over the long term. Of course, growth stocks can be more volatile, but with a balanced allocation, you get the upside potential without taking on too much risk. Let's take a closer look at these tech giants. Apple and Microsoft are household names, constantly evolving and expanding their reach. Nvidia powers the AI revolution, while Amazon dominates e-commerce and cloud services. Google and Meta shape how we connect and communicate, and Tesla pushes the boundaries of electric vehicles. By spreading your investment across these leaders, you're tapping into multiple trends and industries, increasing your chances of capturing future growth. Now let's talk about stability. 20% of the portfolio goes into reliable dividend stocks like Pepsi, Target, UPS, Johnson & Johnson, and Home Depot. These companies have a track record of paying consistent dividends even during tough times. Dividend stocks provide a steady stream of income which can be reinvested or used as cash flow. They also tend to be less volatile than growth stocks, adding a layer of stability to your portfolio. Dividends might not be flashy, but they're powerful. Over time, reinvesting dividends can significantly boost your total returns. Companies that pay dividends are often well-established and financially healthy, which means they're more likely to weather economic storms. In uncertain times, that steady income can make a big difference, helping you stay invested and avoid panic selling. It's a simple but effective way to build wealth over the long haul. Finally, 15% of the portfolio is allocated to crypto, specifically 75% in Bitcoin and 25% in Ethereum. Crypto is known for its volatility, but with a capped allocation you can limit your downside while still capturing the potential for outsized gains. Bitcoin is often called digital gold, while Ethereum powers a whole ecosystem of decentralized applications. This slice of the portfolio is about embracing innovation and the possibility of asymmetric upside without risking too much. Crypto can be a wild ride, so it's important to manage your risk. By keeping your allocation to 15%, you're making sure that even if crypto prices swing wildly, your overall portfolio stays balanced. This approach lets you benefit from the innovation happening in the crypto space without letting it dominate your investment strategy. Remember, the goal is to participate in the upside, not to bet the farm. Let's recap the allocation. 40% in S&P 500 ETFs, 25% in high-growth tech stocks, 20% in dividend payers, and 15% in crypto. Each part has a clear purpose: stability, growth, income, and opportunity. This balanced approach helps you capture gains in good times and stay resilient during downturns. It's a simple, repeatable formula that can be adjusted as your needs and the market evolve. Balance is the secret sauce of long-term investing. By spreading your money across different asset types, you reduce the risk that any one investment will sink your portfolio. This approach helps you stay invested through market ups and downs, avoiding the temptation to make emotional decisions. Over time, a balanced portfolio can deliver strong returns with less stress and fewer sleepless nights. Compounding is one of the most powerful forces in investing. By reinvesting your earnings, whether from dividends, interest, or capital gains, you allow your money to grow on itself year after year. Even small, steady gains can add up to significant wealth over time. The earlier you start, the more you benefit from compounding, making it a cornerstone of any long-term strategy. Diversification means not putting all your eggs in one basket. By investing in different types of assets, stocks, ETFs, crypto, you spread out your risk. If one part of your portfolio struggles, the others can help balance things out. This reduces the impact of market swings and helps you stay on track toward your goals. Diversification is a key principle for building wealth and protecting your investment. Investing isn't just about numbers, it's about mindset. Emotional discipline means sticking to your plan even when markets get rocky. It's easy to get swept up in fear or greed, but the most successful investors stay calm and focused on their long-term goals. By building a balanced, diversified portfolio, you make it easier to stay disciplined and avoid costly mistakes. Many investors fall into traps like chasing hot stocks, trying to time the market, or panicking during downturns. This strategy is designed to help you avoid those mistakes. By focusing on balance, compounding, and diversification, you can sidestep the most common pitfalls and keep your portfolio on track. Remember, surviving the market is more important than trying to outsmart it. It's important to check in on your portfolio from time to time. Are your allocations still in line with your goals? Has one part grown faster than the others? Rebalancing helps you maintain your desired mix and keeps your risk level where you want it. Regular reviews ensure you stay on course no matter what the market is doing. Your needs and goals may change as life evolves. Maybe you want more income or you're ready to take on more risk. The beauty of this approach is its flexibility. You can adjust your allocations as your situation changes, always keeping balance and diversification at the core. Investing is a journey and your portfolio should grow with you. Markets will always have ups and downs. The key is to stay the course and stick with your plan. By focusing on long-term growth and not getting distracted by short-term noise, you give yourself the best chance to succeed. Remember, investing is a marathon, not a sprint. Patience and discipline are your greatest allies. While this portfolio is fully invested, it's always wise to keep some cash on hand for emergencies or new opportunities. Having a cash cushion can help you avoid selling investments at the wrong time and gives you flexibility when life throws you a curveball. Think of it as your financial safety net. Taxes can have a big impact on your returns. Consider using tax-advantaged accounts like IRAs or 401(k)s to maximize your growth. Reinvesting dividends and holding investments for the long term can also help reduce your tax bill. Always be mindful of the tax implications of your investment decisions. One way to stay disciplined is to automate your investments. Setting up automatic contributions ensures you keep investing no matter what's happening in the market. It takes the emotion out of the process and helps you build wealth steadily over time. Automation is a simple but powerful tool for long-term success. Patience is essential for investors. Markets can be unpredictable in the short term, but over the long run, steady investing pays off. By sticking to your plan and giving your investments time to grow, you harness the power of compounding and ride out the inevitable bumps along the way. Good things come to those who wait. Every investor makes mistakes, it's part of the journey. The key is to learn from them and keep moving forward. Whether it's buying too high, selling too low, or getting caught up in hype, each experience teaches you something valuable. Over time, you'll become a more confident and successful investor. The world of investing is always changing. Staying informed about market trends, economic news, and new opportunities helps you make better decisions. Read, learn, and stay curious. The more you know, the better equipped you'll be to navigate the ups and downs of the market. While this video is for educational purposes, seeking professional advice can be helpful, especially as your portfolio grows. A financial advisor can help you tailor your strategy to your unique goals and circumstances. Don't be afraid to ask for help when you need it. Recap: this $10,000 portfolio is built on 4 pillars: conservative ETFs for stability, growth stocks for upside, dividend stocks for income, and crypto for opportunity. Each part plays a unique role, working together to create a balanced, resilient investment plan. This structure is designed to help you grow your wealth while managing risk. A long-term mindset is crucial for investing success. Markets will have ups and downs, but by focusing on your goals and sticking to your plan, you give yourself the best chance to succeed. Remember, wealth is built over years, not days. Stay patient, stay disciplined, and let your investments work for you. Market volatility is a fact of life for investors. The key is not to panic when prices swing. A balanced, diversified portfolio helps you ride out the storms and stay focused on your long-term goals. Remember, volatility is normal and often creates opportunities for disciplined investors. Doing your own research is an important part of investing. Understanding what you own and why you own it gives you confidence to stick with your plan. Take the time to learn about the companies and funds in your portfolio and stay curious about new opportunities. It's easy to get distracted by headlines and market noise, but the most successful investors stick to their plan. By focusing on your long-term goals and ignoring short-term distractions, you give yourself the best chance to build lasting wealth. Trust your process and stay the course. Investing is a journey, and it's important to celebrate your progress along the way. Whether it's hitting a savings milestone, seeing your dividends grow, or sticking to your plan during tough times, every small win counts. These moments build confidence and keep you motivated for the long haul. The best investors are always learning. Markets evolve, new technologies emerge, and opportunities shift. By staying curious and open-minded, you can adapt to changes and keep your portfolio moving forward. Make learning a lifelong habit and watch your investing skills grow. Take time to review your financial goals regularly. Are you on track to meet them? Do your investments still align with your priorities? Adjust as needed, but always keep your long-term vision in mind. Clear goals help you stay focused and motivated even when the market gets choppy. Flexibility is key in investing. Markets change and so do your needs. Be willing to adjust your strategy as life evolves, but always keep your core principles: balance, diversification, and discipline at the center. Flexibility helps you navigate uncertainty and seize new opportunities. Fear of missing out can lead to impulsive decisions. Stick to your plan and remember that slow and steady wins the race. Chasing the latest trend rarely leads to lasting success. Trust your process and focus on what works for you. A simple, well-structured portfolio often outperforms a complicated one. By focusing on a few key investments and keeping your strategy straightforward, you reduce stress and make it easier to stay disciplined. Simplicity is a powerful ally in building wealth. Investing can sometimes feel slow, but staying motivated is crucial. Remind yourself of your goals, celebrate progress, and keep learning. The journey may be long, but the rewards are worth it. Stay focused and keep moving forward. Let's quickly review the key takeaways. Balance your portfolio, diversify your investments, focus on compounding, and stay disciplined. These principles form the foundation of a smart, long-term investment strategy. Stick with them and you'll be well on your way to building lasting wealth. This $10,000 investment plan is all about balance, discipline, and long-term growth. By spreading your money across different assets, focusing on compounding, and staying emotionally disciplined, you give yourself the best chance to succeed. Remember, investing is a journey. Stay patient, keep learning, and let your wealth grow over time. Every investor's journey is unique. Use this framework as a starting point and adapt it to your own goals and risk tolerance. Stay curious, keep learning, and don't be afraid to make adjustments along the way. The most important thing is to start and to keep going no matter what. The future is full of possibilities. By building a balanced, diversified portfolio and sticking to your plan, you're setting yourself up for success, no matter what the market brings. Stay focused on your goals, keep learning, and look forward to the opportunities ahead. To sum up, investing $10,000 wisely means balancing growth, stability, and opportunity. Use broad market ETFs for a strong foundation, add growth and dividend stocks for upside and income, and include a controlled slice of crypto for potential. Stay disciplined, keep learning, and let time work in your favor. There's no perfect time to start investing. The best time is now. Use this balanced, smart, and long-term approach as your guide. Remember, the journey to financial freedom begins with a single step. Take action, stay committed, and watch your wealth grow over time.